I'm Michael Fox, and this is the Prospector News Podcast. And I'm joined by the national investor, Chris Temple. It's the day after the Fed meeting. Chris, welcome.
Well, day after the Fed meeting, and we're all still here.
Yeah, we are. Well, I got to tell you, tomorrow's Groundhog's Day, and I think the Fed saw its shadow, and we've got 6 more months of higher interest rates.
Well, that's sort of what Fed Chairman Powell told everybody yesterday, not to any great surprise. I figured that, and I've said this before, last time you and I talked, I said that the markets were overly ambitious, pricing in how many rate cuts were going to come and how soon in 2024, and that they were overstating both. And that's essentially what Powell told us yesterday, that, while as always these days, more so talking out of both sides of his mouth, he made quite clear that it's going to be a little while yet before they cut interest rates. So and he came out with a few reasons why it could be many, many more months. So we'll see.
Yeah, it's they're kind of a rock but stuck between the rock and the hard place sort of situation, because the economy continues to defy logic, although there's starting to be some cracks showing, and it continues to hum along. Inflation's paring back, but it's really paring back against higher numbers. Jobs keep holding up. You know, it's this great stagflation you keep talking about.
Well, it is, and I think if you boil down Powell's press conference yesterday and the things that he said and answered to different questions and so forth, it's almost as if he was trying to get people to understand one of the tried and true ways that you make decisions in the first place. And that's what Ben Franklin famously said. And you simply take a sheet of paper, and on one side of the paper, you write down the reasons to do something. On the other side of the paper, you write down the reasons not to do something, and you see which side has a preponderance, and maybe overwhelmingly so, of the evidence. And the overwhelmingly for the Fed still, and he basically said this, there is no compelling reason for the Fed to have to lower interest rates anytime soon, but there are a lot of compelling reasons for them to wait. All right. The economy is still healthy as far as the headline numbers, though a lot of and you and I talked about this last time we did one of these, underneath the surface, consumers are weakening. The economy is weakening somewhat. The headline numbers don't reflect it to the extent, in my opinion, that they should. But as I said the other day, you don't need to listen to Joe Biden or Jerome Powell. Listen to the chairman of UPS, which came out with an abysmal report this week, an abysmal outlook that tells you that the US and globally, that spending has been curtailed a lot already. So notwithstanding that, Powell is looking at record high stock prices recently, record high levels of corporate issuance, even at these interest rates, which tell you something. That's number two. And really, so far, no major cracks emerging in the system. Now, some people have made a big deal out of the fact that for whatever reason, they surreptitiously removed a line from their official statement as to the health of the banking system. And some people saying, "Oh, there he is. He doesn't think the banking system is healthy anymore." Well, no, he didn't say that, but he did not say it. So we'll see. There's a couple of cracks that have opened up there that you and I are going to talk about in a few minutes. But bottom line is, and really along the lines of what he's said for a while, inflation, they simply are not going to declare victory yet, and they are not going to move to cut interest rates until they see the whites of the eyes of reliable 2% base inflation rate. And we're not there yet. May not get there still.
No, I'm in agreement with that. The thing I start to wonder about, though, and you know, yeah, they rose the interest rates at a very rapid rate over an 18-month period. But realistically, there's a knock-on effect of those interest rate hikes that come later on, not necessarily the moment that they raise them. Like if a company or a corporation or even, Joe Sixpack, Sally Soccer Mom, has a mortgage. If that mortgage isn't due up for renewal and it's a fixed rate mortgage, they're not going to see the effect of those higher interest rates until that mortgage becomes up for renewal. And that could be, anywhere from 2 to 3 years away from now still. So we're not seeing, you know, declines in the property market as people are forced to sell because they're not going to be able to afford the new mortgage payments yet. So we're not seeing those kinds of cracks. A lot of the corporate debt hasn't been rolled over to the higher rates yet. So we're not seeing, the effects of cutbacks and hits to the bottom line because of higher interest rate payments. So is the Fed going to have to wait until those take into effect before they start to, shall we say, blink and look to actually pivot?
Well, look, I think they're of a mind, to simplify it, Mike, that they're going to actually start lowering interest rates as they have done in other similar times when the recession cat is already pretty much out of the bag. They've got the excuse right now to stand pat of inflation staying chronically high. I don't think they can do a whole heck of a lot more to change that, quite honestly, right now. And that's as things presently exist. There's a couple other things going on in the world we're going to talk to, mostly the announcement from Evergrande this week that could throw everybody's game plans into disarray. But I think that they want to wait until they see. Now, you got to look at what Powell said yesterday. All right. The overwhelming majority of all of his comments were on inflation still is too high. They don't want to move prematurely. He again, even after how much inflation has come down by all the various measures to this point, he still went back to the example of the Fed's mistake in the 1970s, where they let off the brake too soon. Inflation went back up and reaccelerated, and they had to tighten even more. And he basically said yesterday, look, all of you people pining for lower interest rates now, what if I do it and we're right and it is a mistake and it was too early? We got to raise them even more afterward to finish the job. Well, then what are you going to do? You're going to be happy if we have to do that? So that's still his, an underlying message that they really don't want to have to do it. And again, when you look at still the substantial liquidity in the markets, I talked about the stock market, credit markets, and everything that are still nosebleed high, as far as bond prices and stock prices, there's a lot more reasons for them to stay where they're at right now. In retrospect, I have to believe after his comments yesterday that Powell knows how stupid it was to even suggest in his December meeting that maybe they'll start easing sooner. That was a dumb thing to do. He probably knows it now. But he's going to wait until things, he thinks that there's a solid pace of economic activity. Well, that's more of a mixed bag. Okay, but here again, I think the bottom line is they're staying at this level for longer. And he stressed yesterday that longer is probably going to be better than some of you people think.
Yeah. The other part of data that they tend to look at quite extensively is the jobless numbers.
Right.
And I'm starting to have a ponderance, and I'm going to run this past you and see what you think of it. But it's the jobless numbers I'm starting to think are more a demographic issue than they are an economic issue, because we have a good chunk of an aging population that's looking at things and going, you know what, I'm done with working. I don't need to work anymore. I retired. Now they're completely out of the job market and they're no longer factored into these numbers. So when, we have job openings the way they are, and that's these people leaving the marketplace and, the younger people being able to step up into it. But it artificially the demographic is shrinking and it artificially, makes the jobless numbers look better than they maybe in fact are.
Well, I think you're right about that. And that's true in a lot of nations, some of them even worse instances than the US. It's why, rather than opening up the borders as Joe Biden has done in the US, we need a sensible immigration policy that does allow people in who can or who are here to fill jobs, not to sell drugs or to engage in child trafficking or do whatever else. We should need to have people have more children. We need a lot of different things. So demographics definitely is a part of it. And in some industries, you've got a major crisis of lack of skilled labor. Most of all in extractive industries that we need more than ever for future energy and infrastructure and green energy needs. And there's no people to fill these jobs. I was just reading about something on that subject again this morning, and that's going to keep upward price pressure on a lot of different commodities because it's going to curtail the level of production which we should have because there's just not enough people. So you're right that this is a part of the equation, no question. And so the other aspect of that too, and what this has led to is that businesses of all kinds to attract more people, they've got to pay more money. And this is one part of the equation. It'll be interesting to see what tomorrow morning's numbers bring on Friday when we have the January numbers. But wage gains are still well over 4% annualized. The Fed, doesn't would rather not see that. The Fed is still trying to say that long-term inflation indications are well contained and all this other crap. Well, tell that to all these workers that have been getting big raises and the companies that have paid them because they need to keep these workers. I don't think so. We've got a wage price spiral. Maybe not as overt as what was in the 70s, but we've got one. So, I think that the whole idea, as I mentioned a minute ago, Mike, of so little needed labor for a lot of different individual industries, this is all part of where sensible central planning would be an advantage if we had sensible central planning, but we don't have sensible central planners. So this is why we're in trouble in all of these different areas.
That's central planning. That's a government function, isn't it?
Supposed to be.
Well, see,
Now,
there's the
now
problem. We
people,
haven't gotten
pe-
anybody sensible in government for decades.
some of my libertarian friends will disagree. They will let the markets take its course, but we haven't had a market economy to be, the truth be told, for a long time. We have varying levels of socialism and subsidies for every part of our economy, but they're not driven by economics and common sense and the betterment of the people. They're driven by interest groups, that cater to one major political party or the other, and that's why things are all askew.
Yeah. Well, that's a good segue. Let's leave the West and the Fed, and let's look at the socialist utopia of China. There's a big ass mess happening over there that has ramifications worldwide. Let's talk about Evergrande.
Well, Evergrande, as some people remember, you and I have talked about it from time to time. Evergrande officially got into some trouble and was quasi taken under some care by Chinese authorities. I think it's over 2 years ago now. It's the single largest and most heavily leveraged real estate enterprise in the history of planet Earth. When they first got into trouble, the Chinese authorities took it over and said, well, this time we're going to allow the markets to function. So understanding the dire straits that Evergrande was in, Chinese authorities said we're going to manage what they call a marketized default of Evergrande. Now, to back up a step as to how this came to be, a lot of people today, you call it the socialist utopian. I know that was partly tongue in cheek. The chest thumping yahoos on Fox News always have to refer to the CCP, the Chinese Communist Party. There is a lot less communism in China's economic system of government and priorities in recent years than there is Keynesianism and fractional reserve banking run amok. All of the mistakes that have been made in that respect by the US, with the subprime crisis, for example, with other bubbles that have been blown by the Fed and augmented by fiscal policy, China has done it all bigger and better, or in this case, worse, to the point where they allowed such asinine use and abuse of credit and leverage and so forth, all leading to this so-called Chinese miracle. That what is this miracle given China, and now by extension, because we're all going to suffer the consequences, the world. You've got a debt to GDP ratio, if you include the shadow banking system, and a big one of the shadow banks in China just went belly up as well. Well over 300% debt to GDP ratio. That's triple the US. It's half again more than Japan. It's double Europe. And I don't care how much China has kicked the can down the road. At some point, even they, with their command and control economy, can no longer fight the laws of mathematics. And that's what we learned this last Monday, January 29th, right at next to, I think it was September the 8th, but correct me if I'm wrong on a date, folks, when Lehman officially went bankrupt here in the US, because that's what just happened in China. And when Evergrande was officially declared bankrupt and ordered liquidated by a court in Hong Kong on Monday, by the time that verdict came out and what's left of the company's public equity was halted, you've got public equity remaining in Evergrande of $275 million and outstanding debt still of $328 billion. That is several times Lehman Brothers. And worse than Lehman Brothers, the majority of this debt that Evergrande owes is to non-Chinese entities, many of them US and other Western investors. In fact, the majority of that paper, because back when everybody was buying into the whole Chinese miracle and China's the new economic juggernaut and they're going to supplant the US and blah, 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 everybody was throwing money at China, just like they throw money from time to time at cryptocurrencies, or they throw money at AI stocks, no matter the valuations, and all of these different kind of things. And so now that Evergrande has been deemed by a court to be an official bankrupt and not an unofficial one, that Chinese regulators and people in the government and in the financial system over there were trying to figure out how to back and fill and sell assets at fire sale prices and enforce haircuts on investors. That's gone as far as it can. The latest efforts by Evergrande to buy more time and make a broad deal with creditors just isn't going to happen, and that's why it was shut down. So it's going to be interesting to see the fallout. There are things that are going to happen as a result of this, very likely, that the world has never dealt with. There's the potential at the same time for the US, not under current leadership, unfortunately, but for the US to gain a much more substantial economic upper hand. Once again, that's the good outcome looking at this from a mercenary standpoint as an American. The downside is that if China, which has already seen a major exodus of money out of its markets, and I can't stress this enough here, folks, and I say this from time to time, if you are listening to anybody right now telling you that you need to buy this, or you need to buy this, that, or the other thing, or buy my book, or buy whatever, because China's about to supplant the US is the king of the hill in the world, and we're going to have a China currency that's going to replace a dollar. Don't walk away, run. Those people are full of more shit than a Christmas goose, because anybody with half a brain has been pulling money out of China. And to me, the interesting thing to watch about this is, with that already in play, with the whole move away from globalization already well underway in many ways, does China just say, all right, you Western investors, everybody else, you're going to get in line with everybody else. We're not doing anything special for you. Maybe we'll even just let them default on this debt and see how you like it. You got tens and tens and tens of billions of dollars vaporized on the balance sheets of US institutions. How is that going to work for geopolitical stuff? How is that going to work, at least presently, for any notion that anybody outside of their own sphere of influence wants anything to do with China going forward? I mean, this is a financial and political and geopolitical mess over this, that we're going to see this. It's not going to be, I don't believe, as sudden and dramatic necessarily as what happened in the wake of Lehman going bankrupt, and the Congress didn't want to bail them out and everything collapsed for a while. But it's going to happen in slow motion, probably for a number of years, and there's going to be all kinds of side issues and side effects and everything else from this, that we can speculate in an educated way, because a lot of the stuff that's going to happen are going to be extrapolations of things already going on between China and the West generally, and China and the US specifically.
Yeah, I liken this, although, I agree the ramifications of this are going to be, years. But it's like someone has, been playing with a hand grenade and finally pulled the pin out. And
Well,
we don't know what kind of damage it's really going to do. But,
we don't yet.
here's the reality, and a lot of different fronts. When Lehman Brothers collapsed, it froze up the world's credit markets. Banks stopped lending to other banks, and that then went down to the consumer, the corporations, mortgages, everything. And this being bigger than Lehman Brothers, does this, we talk, circling back to the Fed again, was this what Jerome Powell saw in February when he took his more, laissez-faire approach to the interest rates? Did he see this coming and went, well, we might need to pivot sooner in order to keep the credit markets moving?
Well, we speculated about that at the time, and I know you meant that the December meeting, when he was more dovish than people expected. But look, one of the ways in which you mitigate the fallout that's going to come from this, and the destruction of a lot of balance sheets that's going to come from Evergrande, is that you've got to find some other way to goose the markets, real or artificial valuation, to compensate as best as you can for it. China itself right now is trying to figure out how to at least slow down the bleeding. They're talking about injecting money directly into the stock market, like Japan has done on and off for years, to little avail, but they've done it anyway. And they recently reserved 50 basis points in one whack, which is more than typical. They reduced reserve requirements to try and help add some liquidity and shore up the banking system. But again, this is a problem of many years making. It was famously pointed out in the decade before the financial crisis here, that when China had its really monster run from I'm just using approximate numbers, like 2002 and 3 to 2007 and 8 timeframe, they were building the equivalent of the city of Houston every month in that country. And it was all on paper. It was all on debt. And the debt fed more debt. And you had, and here, people still, as I, sarcastically said a few minutes ago, talk about socialism and communism. There was more kleptocratic capitalism in China and Keynesianism that led to this debt colossus. And I don't know if they had that much hubris themselves, thinking that we really are going to be the next king of the hill and we can get away with this. We'll figure out we'll take on all this debt now, build all of this stuff now that we don't need quite this fast, and figure out how to service it later because the world's going to beat a path to our door, or what they were thinking of. But this is how they got into this mess, is from the most ridiculous and extreme and irresponsible use of credit, including lots of winks and nods and graft and everything. There's all kinds of stories about how some of these small and mid-tier builders of real estate projects, some of the leaders of local governments, all kinds of incentives for them to approve projects that weren't needed, because the credit spigot was wide open. So you do all kinds of stupid stuff. But now, if they're lucky, the economy it's already started. They're going to settle into this long Japan type funk that's going to go on for years. That's if they're lucky. If they and the rest of us aren't lucky, the dominoes from unwinding what's left of Evergrande, and it's still, like I said, you got $1/3 trillion debt pile. The rest of us are going to get dragged along with it to one extent or another. May be less bad, relatively speaking, in the US than it is in Europe. Europe's got a lot of money at stake in this, and they can afford it less than the US can, relatively speaking, in the US financial system. But it's going to hurt everybody. And as you said a minute ago, it is going to dampen those animal spirits. It's going to lead to a broader risk-off attitude where credit, even if the Fed lowers rates, won't matter. Credit's going to be a lot harder to come by.
Yeah, well, again, Lehman Brothers essentially put us into a short, harsh recessionary period, and this is bigger.
Right.
I also look at this, and I think this puts the pin into that discussion where China had an advantage because their leadership looks at generational planning rather than 4-year plans that land up with election cycles. Um, if this was generational and planned, this is a generational screw up.
Well, it is. And listen, I don't have any doubt that probably after you and I are dead and gone, and China gets out from under this, and the US gets knocked down a few pegs, all of which I think is going to come in the coming years, 30, 40, 50 years down the road, China's probably got the strongest economy on the planet. And by that time, to go along with it and helping to enable that, they probably will have more modern, transparent Western style markets than we do, but they got a hell of a valley to go through before they get there. And most people still don't get this. The amount of stuff I still see out there, from these people. Oh, we're gonna have a Brics currency backed by gold, and China's going to be the anchor of it, and China this and China that. I want to throw up at the idiocy of some of this stuff, because that is far from the present reality.
Yeah, no, I agree. Let's put the hold on the BRICS discussion for a second,
Yeah.
because I do want to come back to that. But I also look at this in the terms of the credit markets. So if credit dries up, let's say they decide that the West is going to take major haircuts. So the West stops lending to the East, messing up their credit markets. We're still buying an awful lot of goods from China and a lot of Chinese influenced, local countries in Asia. Are we getting into a situation where these companies don't have credit, therefore they can't produce the goods that we're wanting to buy, and we end up back into these severe supply chain issues again, and inflation comes back out of the bottle and runs amok further in the West?
That's very possible, because a lot of this can lead to exactly that, this curtailment of credit and economic activity and so forth. People need to remember, among other things, Mike, and I know you're alluding to this, that every day the goods that traverse the globe are done so by letters of credit. Nobody pays cash on a barrelhead. when a shipment leaves a port in China and is bound for San Francisco or wherever, or Seattle, you've got credit. Everything is done with credit on these things. That's one of the reasons why the global economy went into such a quick tailspin in the wake of 2008, is you couldn't even get those letters of credits in some circles to ship goods, because nobody operates on cash. Everybody operates on, net 30 days or net 14 days or whatever. So yeah, you can extrapolate what is likely to happen to some extent and say, okay, well, to some extent, we are going to see a slowdown in shipments. We're going to see a slowdown in activity, and therefore the prices of stuff that does get shipped is going to be higher. No question about that. And this is where, and I don't have all the answers to this. I'm not pretending I do, but I can tell you what some of the dangers are. And whether we avoid those dangers in whole or in part is going to take some really good, serious leadership. And so we're already short of that, at least in this country. Does a U.S. president say to China, okay, well, your Evergrande sucked $200 billion of stupid money out of our financial institutions. How do we smooth this over? Until we get our own act together, are you going to drop your threats to reduce rare earth materials and technology? Are you going to drop your threats to not export graphite? Are we going to maybe suspend our chip making wars? Or in the alternative, the things going the other direction. Now, if I was Xi Jinping, I'd say, well, look, you people are the ones that said you wanted free markets and capitalism. Free markets worked when your companies invested money in Evergrande. Now the market is going to work to figure out how much of a haircut they're going to take as we unwind this. That's your system. What are you bitching about? So it's going to be a mess. I mean, you're going to see currencies and commodities and maybe even is China going to say that we'll step back from the South China Sea? We got to tend to figuring out our economic mess at home. Or the flip side again, seeing the inevitability in front of them, does China say, okay, we'll let everybody go down and we'll have a global financial crisis because we're going to be able to emerge from it faster than everybody else, and we're not going to give in on commodities. We're not going to give in on our regional territorial ambitions and so forth. So there's a whole barrel full of what. Everybody's going to start smelling this more and more. So we're plowing new ground here.
Oh, absolutely plowing new ground. The other question that, there's so many elephants in this room, there's barely room for the two of us in it. Deglobalization, is this going to speed up the deglobalization movement? Because, we can no longer rely on China companies to be able to function well enough to continue to keep the supply chain. Is this going to speed up the rehoming or the near homing of manufacturing? I was reading the other day, Mexico is now usurps China as the leading importer into the United States.
I think that is one of the more likely and probable outcomes. Absolutely, Mike, because, I don't know that at this point, when you've already got this multifaceted move away from globalization and everything already underway as a result of that, I don't know how China at this point is able to smooth that over and reinstill confidence in its markets anytime in the foreseeable future. There's a lot of Western companies that have already shut down some of their Chinese operations, as some of our listeners have read and heard. Otherwise, you've got, as I pointed out earlier, just look at what's happened to the Chinese stock market in the recent past. Look at the outflows. Net investment income into China has turned negative for the first time in a long time last year. And again, this is a big vote of no confidence. So you have to ask yourself, and we're just speaking hypothetically, is it worth the time and pain and cost to China now, when most of the rats have already left to say, hey, we're doing this and this and this, rats turn around and come back onto the ship? Or do they just let nature take its course, realizing that the future, at least in their part of the world, likely still belongs to them? I'm not saying anything to the contrary of that. And that, well, we're all going to bottom together, but we're going to use that as an opportunity to crack down where we've got to crack down on our own rulemaking and our own economy and so forth, so we don't let such stupidity happen again. And maybe they'll even borrow one of Sleepy Joe's phrases and say it in China, after all of this settles, we're going to build back better. And they'll sell everybody else in the world on that, because after all, China does have a pretty good whack of gold, and so does Russia, and so does India. And I still believe, and I'm not saying anything different, that long term, there will be something like the Brics or some version of that, that is its own block with its own economic rules and so forth, will be a major force in the world. Whether I live to see it or not is another story. And that's my only point. That sure as hell isn't going to be any time in the near term.
No, which, you jumped the gun on my next question is, when China was meant to be the big support of the BRICS nations, as they try to either create a new currency, if you believe some people, or come up with an alternative means of economy between these nations. With China supposedly being the big backer of all of this, what does this fiasco do to that premise? How far on the back burner does it put it?
Well, it sets it back to a point, but don't forget too, Mike, that a big part of the motivation of BRICS is not positive. It's the hatred of Western and chiefly US imperialism that they lived under for a very, very long time, and they want to get out from under. And fair enough, and I believe me, when you look at what US policies have done in much of the world for decades now, certainly since the end of the Second World War, I can't blame anybody for disliking it and wanting to, have a life where they can get up in the morning and go to bed at night and prosper without having to do it based on this country's dictates, or where the lion's share of the spoils go to this country. So I've never squabbled with the motivation behind it, but that motivation of hating the US isn't enough to put together a viable first world, modern, transparent banking and currency system. It's not now and never will be. But I think that all of the stuff to come, China will, deflect like all politicians do of any country, of any political party, and they'll blame everybody but who caused the problems. And I've said before in this context, that if there were a collapse in China, China's sales pitch to their own people and to people in their region will be, this is what we get for playing along with the West and playing their game of reckless capital and so forth. And we need to have learned our lesson. We need to rebuild together, and they'll bring in other countries into their fold. And I think long term that they will do so successfully. So again, I'm not saying that long term you won't have a BRICS or something of that fashion that will be viable, but all it is today is an academic exercise as far as the large picture goes. But I've also said, as you remember, because you and I have talked about this, that it is meaningful today that without any BRICS bank or BRICS currency, that a lot of the countries in this bloc have begun to do business with one another outside the US dollar and in their own currencies. That matters, long term, and it will benefit them long term.
You alluded to, the Chinese maybe utilizing this as a crackdown, and I'd be in the minority on this. I don't see how they can do that. Like I look at, very popular 1980s movie Trading Places with Eddie Murphy and Dan Aykroyd.
Right.
And one of the biggest lessons that you get out of that movie is, how to hurt rich people, turn them into poor people. And
That's
with
right.
a large kleptocracy in China and burgeoning middle class, how well are they going to stand for being cracked down by the authorities before they turn?
Well, I don't know if I should have put it in such a way as that, honestly, Mike. I wasn't thinking as much in those terms of cracking down on the people and the population, but cracking down on bad practices. And look, there was an awful lot of I mean, the number of envelopes that changed hands, at least figuratively speaking, in China for years now, over building this step monster was every bit as onerous or more than what you hear from other third world countries or South America or this country, even when it comes to lobbyists. I mean, they again in building this debt problem that now has finally come home to roost. They outdid anything the U.S. ever did in those areas. So, yes, it's going to be a challenge for them to keep things on an even keel and not have so many people slip back into poverty. Because here again, and this is another wrinkle to this whole thing. Do Chinese authorities push for? Because there's a question as to how much the Hong Kong courts are going to be able to do and how much they're going to be compelled to do by Chinese mainland authorities who don't want this to get any more out of hand than it's already getting. But do they have a multiple choice outcome? Because for sake of discussion, you've got a number of suppliers that were suppliers of materials, subcontractors and whatnot to a lot of this overbuilding of real estate that Evergrande engaged in or financed. Do they get favorable treatment because they're Chinese? And does that mean that there's less to pay creditors, financial creditors and investors later on? Time will tell. So I do think it's going to be a major task for them to figure out how they're going to, keep society in line and not let the overall economy collapse too much. And maybe they can pull it off. I don't know. But to me, the more near-term concern is what kind of contagion is there? Again, it's very unlikely to be as sharp and sudden as after Lehman Brothers went bust, but the math is the same.
Yeah, and I, as much as I, don't want to be sympathetic, but I am sympathetic to the Chinese problem on this because, somebody's going to have to take a haircut on this, and they're going to have to figure out a balance and how that's done. Otherwise, they're going to run the risk where the Western banks start calling loans all over their institutions, because they no longer trust their ability to get paid back.
Well,
And
that again,
that could spiral that country into a greater crisis than what Evergrande even is.
that's very possible. When all of a sudden, it's like the run on the bank, proverbial run on the banks that you had in the Depression. Everybody knows that there's no way for everybody's debts to be made whole all at once. Everybody knows that there's leverage on top of leverage and on top of leverage. And in terms of derivatives markets, we don't even use the term trillion, we use the term quadrillion globally. But that's all vapor, and that vapor can go away fast. And it will impact real world economic activity if it gets out of hand. And so I think that that's something that policymakers have to be cognizant of. I'm sure the Fed, even though to my disappointment, Fire Marshal Jay didn't get asked about this yesterday in his press conference, but believe you me, I guarantee you that a hot topic at the Fed meeting that was not in their minutes or their notes afterward, nor will be in their minutes most likely, was Evergrande.
It'd be foolish if it wasn't. Let's swing this all the way back to the start again, where we were talking about the Fed. Given the situation with Evergrande and its multitude of tentacles that's coming out from this, it has the potential of being inflationary by putting supply chain issues on. It's got the potential of being recessionary because it could freeze up all the credit markets for everybody. Does it deglobalize? Does it put pressure on Western banks? Are the banks in trouble? You can see where this could lead to higher interest rates. It could lead to lower interest rates. It could even lead back to quantitative easing again, although they'll probably find another name for it because they don't want to call it that anymore. Your thoughts? It's a mess.
Well, again, I mean, we're plowing new ground here. Yeah, we could have part of the above, all of the above, none of the above. I'm probably not gonna get none of the above, but um, who knows? I mean, this is really gonna be a major challenge because you're gonna have massive deflationary forces unleashed in markets. You're going to see the obliteration of hundreds of billions, maybe trillions of dollars worth of derivative valuations, CDO valuations, all the rest of this stuff like happened in the wake of Lehman. That will lead to some contraction in credit. It will lead to some reduction in spending for businesses and individuals alike. It's going to be hunker down mode and shore up, circle the wagons mode for everybody, no matter who you are or what your station in life. The question is, when you add in this wrinkle of upward pressure on prices for most things, because of the lack of credit, because of lack of supplies, because of what already we see, and we've had this discussion about commodities on and off for a while, already structural lacks of supply. Will the global economy go into a tailspin so much that it won't matter? Or will this be the worst part of the great stagflation, is that as things weaken and as credit dries up, things that you need for everyday life get even more pricey than we thought? Stay tuned.
Yeah, stay tuned. If people want to follow your ongoing thoughts about this, because I think are going to be ongoing thoughts.
Oh
I
yeah.
think I think we have found what we're going to be watching in 2024, really early in 2024.
Yep.
How would they do so, Chris?
Just go to nationalinvestor.com, and if you're not already on my email list, make sure you sign up.
Absolutely interesting times, and I'm sure we're going to be talking about this in future podcasts for sure.
No question about it. This story is only starting.
Yeah, no kidding. You mentioned about Powell not saying much. I don't think he had a whole lot of time to react to it, given it came out Monday and his announcement was Wednesday morning. So,
We'll see.
okay, thanks for joining me, and I look forward to having you back.
Take care, Mike.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.